This is a Brazilian real, a 100 real note. The face of the republic staring back at you, promising stability in a country that has seen its currency collapse 6 times in the past 50 years. Every generation of Brazilians has lived through a monetary crisis. The Cruzeiro, the Cruzado, the Cruzado Novo, the Cruzeiro Real. Each one a promise that this time, stability would last. Each one eventually broken. The real was supposed to be different. Created in 1994 under the Plano Real, it was designed with safeguards, central bank independence, inflation targeting, fiscal responsibility rules that its predecessors lacked. For 30 years those safeguards held. The real became Latin America's most stable currency. Brazil became the world's 8th largest economy. The cycle of crisis and collapse seemed finally broken. On January 20th, 2026, the cycle announced its return. At 3:15 p.m. Brasilia time, Brazil's central bank reported that foreign exchange reserves had fallen below $180 billion for the first time since 2007. That number, $180 billion, isn't just a data point, it's a threshold. Below it, Brazil's ability to defend the real against speculative attack becomes questionable. Below it, the arithmetic of debt sustainability begins to fail. Below it, the safeguards that were supposed to make Brazil different start looking like the same fragile promises that collapsed every previous currency. The reserves didn't disappear overnight. They've been draining for 18 months, spent defending a currency that markets increasingly believe cannot be defended. The question is no longer whether Brazil has enough reserves. The question is whether spending those reserves is making the problem better or worse. This is not about Brazil having a bad quarter. This is about a debt trap closing around the 9th largest economy on Earth, and about $180 billion in reserves that may not survive the attempt to escape it. Here's what they're not telling you. Brazil's fiscal situation deteriorated gradually, then suddenly. The gradual part happened between 2014 and 2023, a decade of deficits that pushed public debt from 52% of GDP to 74%. High by developed country standards, but manageable for an economy with Brazil's growth potential and commodity wealth. The sudden part happened in 2024 and 2025, when the Lula administration's spending programs collided with interest rates that made servicing existing debt nearly impossible. Brazil's benchmark interest rate, the Selic, currently stands at 13.75%. That's the rate the central bank charges to fight inflation that remains stubbornly above target. At 13.75%, the government pays more than 7% of GDP annually just in interest on existing debt. Not paying down debt, not funding programs, just interest. To put that in perspective, Brazil's entire education budget is 5.7% of GDP. Its healthcare budget is 4.1%. The government spends more paying bondholders than it spends teaching children or treating the sick. And every year the debt isn't paid down, the interest compounds. The hole gets deeper, the escape gets harder. President Lula came to office promising to reverse austerity, to rebuild the social safety net, to restore Brazil's position as a leader of the global South. Those promises required spending. Spending required borrowing. Borrowing required rates that the market would accept. And the market, watching Brazil's debt trajectory, demanded higher and higher rates to compensate for the risk that the debt might not be repaid. The trap was sprung in October 2025, when Brazil's 10-year bond yield crossed 15%, a level that makes long-term borrowing prohibitively expensive. The government can still sell short-term debt, but rolling that debt every few months means constant exposure to market sentiment. One bad auction, one credit downgrade, one political scandal. Any trigger could cause a failed auction, which would force the central bank to intervene, which would drain reserves further. This is the doom loop. High debt requires borrowing. Borrowing requires market confidence. Falling reserves undermine confidence. Undermined confidence raises rates. Higher rates increase debt service. Higher debt service requires more borrowing. The loop has no exit that doesn't involve pain, either imposed by policy or imposed by markets. This is where the lie becomes unsustainable. To understand why $180 billion in reserves isn't enough, you need to understand what reserves are supposed to do, and what happens when they're spent defending a currency that fundamentals say should be falling. Foreign exchange reserves serve 2 primary functions. First, they provide import cover, the ability to pay for essential imports if export revenues dry up or capital markets close. The standard benchmark is 3 to 6 months of import cover. Brazil imports roughly $20 billion per month, so $180 billion represents 9 months of cover. By that measure, reserves are adequate. But import cover is the easy calculation. The harder calculation is external debt coverage, the ability to repay foreign currency obligations if markets refuse to roll them over. Brazil's external debt totals $682 billion. Of that, $234 billion matures within the next 12 months, short-term debt that must be repaid or refinanced in 2026. If foreign creditors refuse to refinance and demand repayment, Brazil would need to source $234 billion in foreign currency. Its reserves are $180 billion. The math doesn't work. The standard metric for reserve adequacy against external debt is the Guidotti-Greenspan rule. Reserves should cover 100% of short-term external debt. Brazil is currently at 77% coverage and falling. Every month, the central bank spends reserves defending the real. That coverage ratio deteriorates. At some point, maybe $150 billion, maybe $130 billion, the coverage becomes so inadequate that holding reserves becomes pointless. Markets attack because the defense has already failed. The central bank spent $23 billion defending the real in Q4 2025 alone. If that pace continues, reserves fall below $150 billion by April, below $130 billion by June, below the threshold where rational defense is possible by summer. At 8:45 a.m. New York time on Wednesday, Fitch Ratings placed Brazil on negative outlook, one step below downgrade, but a clear signal that downgrade is coming unless fiscal dynamics change. The statement cited persistent primary deficits, elevated debt service costs, and diminishing reserve buffers as key concerns. When rating agencies start using phrases like diminishing reserve buffers, they're preparing the market for bad news. When reserves drain to defend an indefensible position, the defense makes the eventual collapse worse. The central bank is caught in a paradox that has destroyed currencies throughout history. If they don't defend the real, it collapses immediately. A collapsing currency triggers inflation as import prices spike. Inflation forces higher interest rates. Higher rates crush economic activity. The recession that follows destroys tax revenue. The fiscal position deteriorates further. The debt becomes even less sustainable. If they do defend the real, they burn through reserves that they'll need when the defense finally fails. A weaker reserve position means less capacity to manage the eventual devaluation. Less capacity means a more disorderly adjustment. A more disorderly adjustment means deeper crisis. The choice isn't between stability and crisis. It's between crisis now with more reserves or crisis later with fewer. Every dollar spent defending the currency today is a dollar unavailable to manage the collapse tomorrow. Brazil's central bank knows this. Their intervention pattern suggests they're trying to manage an orderly decline rather than hold a fixed level. The real has fallen from 4.95 to the dollar in January 2025 to 6.34 today, a 28% depreciation that they've allowed to happen, while spending $47 billion in reserves to prevent it from happening faster. The strategy is rational, but may be insufficient. If markets conclude that 6.34 isn't the bottom, that the real could fall to 7.00 or 8.00, or wherever equilibrium actually lies, they'll sell now rather than later. The selling pressure forces more intervention. The intervention drains more reserves. The depleted reserves convince more sellers that the central bank can't hold. Another doom loop, running in parallel to the fiscal loop. Less than 60 days remain before Brazil's debt ceiling deadline on March 15th. The government must either pass legislation to raise the debt ceiling or breach it and face automatic spending cuts mandated by the Fiscal Responsibility Law. The political battle over that ceiling, between Lula's Workers' Party seeking to protect social spending and the congressional opposition demanding cuts, is consuming the government's bandwidth exactly when they should be addressing the reserve crisis. The market is watching both deadlines. The reserve decline and the debt ceiling are linked. A political failure to address fiscal sustainability will accelerate capital flight, which will drain reserves faster, which will undermine confidence in the fiscal path, which will make the political compromise harder. The loops connect, the traps reinforce each other. While one side defends, the other side sells. The entities driving capital out of Brazil aren't speculators, not primarily. They're pension funds and insurance companies and corporate treasurers who have fiduciary duties to protect their portfolios. In 2024, foreign portfolio investors held $287 billion in Brazilian assets. Stocks, bonds, real estate, direct investments. That number has fallen to $219 billion as of December 2025. $68 billion in outflows, roughly 3% of Brazil's GDP, moved offshore in 12 months. Not because investors wanted to hurt Brazil, because their risk models told them to reduce exposure to a country whose fundamentals were deteriorating. The outflow pressure shows no sign of easing. This week's positioning data from the B3 exchange shows foreign investors net short 47,000 real futures contracts, a bet that the currency will continue falling. Domestic investors, meanwhile, are moving savings into dollar-denominated assets at the fastest pace since 2015. Brazilians themselves don't trust the real. When domestic capital flees alongside foreign capital, the central bank is defending against its own citizens as well as international markets. That's a fight no reserve stockpile can win. The reserves aren't large enough to buy back every real that Brazilians want to sell. At 6:30 a.m. Sao Paulo time on Thursday, Brazil's largest private bank, Itaú Unibanco, published a research note recommending that clients reduce real-denominated fixed income exposure by 15% and increase dollar allocation until fiscal clarity emerges. When the nation's premier financial institution tells its clients to sell reals, the signal reverberates. Other banks follow. Asset managers adjust. The recommendation becomes the catalyst for the selling it predicted. This is what a currency crisis looks like in slow motion. Not a single dramatic collapse, but a gradual loss of confidence that accelerates as each defense depletes the resources available for the next defense. The real won't die in a day. It will weaken, week by week, with occasional interventions that create temporary rallies, followed by renewed selling that erases the gains, and then some. The central bank will announce confidence-building measures. The government will promise fiscal reform. Rating agencies will issue warnings that escalate from outlook negative to downgrade watch to actual downgrade. Each step will be reported as news. Together, they form a pattern that historians will recognize as the seventh Brazilian monetary crisis, different in details, identical in dynamics, to the six that came before. Some will look at Brazil's situation and see resilience. We'll trust that $180 billion is substantial. We'll assume that a country with Brazil's resources, the agricultural powerhouse, the oil reserves, the industrial base, cannot truly face a currency crisis. We'll believe that the safeguards built into the real in 1994 make it fundamentally different from the currencies that failed before. These are the same voices that said Argentina's currency board made the peso collapse-proof, that said Turkey's reforms made the lira crisis-resistant, that said emerging market fundamentals had permanently improved since the 1990s. The voices are always confident until the confidence is proven misplaced. Others will track the reserve drawdowns. We'll monitor the external debt coverage ratio. We'll notice that $234 billion in short-term obligations versus $180 billion in reserves is arithmetic that doesn't work. We'll understand that every month of defense makes the eventual adjustment more severe because the reserves won't be there to manage it. The informed are not predicting Brazil's collapse. Predictions require certainty that doesn't exist when political decisions can change trajectories overnight. What the informed recognize is that the current path leads somewhere bad, that the reserves being spent to defend that path accelerate the arrival at that destination, and that somewhere between $180 billion and zero lies a threshold where defense becomes impossible and adjustment becomes mandatory. This is not financial advice. This is not a recommendation to short the real or sell Brazilian assets or take any position based on emerging market risk. This is simply an observation about what happens when fiscal deficits compound, interest rates crush budgets, reserves drain in defense of an indefensible position, and political systems prove unable to make the choices that mathematics requires. The 100 real note in your hand still works. It still buys coffee and pays bills and functions as money throughout Brazil. But the reserves backing that note are draining. The debts denominated in that note are compounding. The confidence sustaining that note is eroding, and the safeguards that were supposed to make the real different from every currency Brazil has killed before are proving to be exactly as fragile as the safeguards that failed in 1990, 1986, 1967, and 1942. $180 billion left, 60 days to the debt ceiling, $234 billion in external debt coming due. The math is the math. Brazil can change its politics, it can change its policies, it can change its government. It cannot change the math. And right now, the math says the reserves aren't enough. Not to defend the currency, not to cover the debt, not to stop what's coming. That's not pessimism, that's arithmetic. And arithmetic, unlike politicians, doesn't negotiate.